everyone, and welcome to my YouTube channel where I teach lessons in economics useful for students of class 11th and 12th. This is a brand new series, Introductory Macroeconomics, and let's move into the first chapter, that is National Income and Related Aggregates. In this chapter, we will be studying all about how a country earns its income, what are the ways used to measure it and calculate it, and finally, aggregates that are related to national income. The biggest question which makes us reflect on national income is, why do we witness poverty? Why are some countries classified as rich while other countries are classified as poor? Why are some countries classified as developed nations while some countries are called as underdeveloped nations? Is it because they do not have any resources from which they can produce goods and services? Or is it because of lack of proper management? The question is supposed to be answered in this chapter, National Income and Related Aggregates. Countries in Africa are sitting on huge quantities of natural resources, and yet they are classified as underdeveloped and poor countries. So, it is not because of their limited resources that a country is called as poor, but it is because of the way in which these resources are utilized and products are produced favorable to the situation. For example, if a country has natural resources which are suitable for cultivation of sugarcane, and instead of that they try to cultivate some other crop, that is mismanagement of natural resources. So instead of focusing on something else, if that country produces sugarcane to the maximum quantity, that will make this country developed and rich. For example, we can use a practical example of 500 rupees. A person can choose to use 500 rupees to spend on clothes or fashionable items. You can also choose it to put that 500 rupees in your savings bank account. And you can also put those 500 rupees in the stock market. Now, the person who has utilized the 500 rupees for fashionable items has already spent it and finished it. The person who has put that in the bank will get interest and 500 rupees will be multiplied. And if a person is lucky in the stock market, that person can convert the 500 rupees into much more. And so it is not about the availability of resources, it is the way in which resources are utilized which makes a country either rich or poor. In this chapter, we are going to study how an economy has resources, utilizes it, and measures it at a national level. In order to understand the concepts in this chapter, we have to have an introduction where we learn basic concepts and basic terms. These basic terms will be helpful not only to understand about national income, but they will also be very, very useful so that we can study economics in a much clearer and better way. So this video is all about basic concepts. Let's begin with the first concept, that is consumption goods. It's very easy to understand. Goods which satisfy human wants and utility and the utility of these goods, whenever they are being used up, they are called as consumption goods. For example, whenever we are hungry, we eat food. So any food item can be considered as consumption goods. First of all, why? Because they satisfy our want of hunger. And secondly, the utility or the want satisfying capacity of that product can be used by us. The same can be told for clothes. Whenever we want to cover ourselves, we purchase clothes and we use them, we consume them. So it satisfies the need of covering ourselves, and the utility of clothes is used up by human beings. So all those goods who satisfy wants and the goods whose utility can be used up are called as consumption goods. The second kind of concept or the second kind of goods are called as capital goods. Now these kinds of goods are used to produce other goods and services. For example, machines. Now when we purchase a machine in order to produce goods, this machine helps us to produce other products. So in this way, this satisfies the need to produce, and the utility is used up in order to produce further production. And so these kinds of goods which are helping us to produce other goods are called as capital goods. Remember the difference between consumption and capital goods? While consumption goods are satisfying the needs directly to the consumer, capital goods are used in production of other goods and services. Let me try to clarify these two concepts with the example of a house. Now, whenever we need shelter to sleep, to stay, to enjoy, to live life, we have a house. So in this situation, when we use a house, it will be consumption good because the house is satisfying the need of human being, and that is shelter. But if we use this house in order to establish our business or try to produce goods so that it acts as a warehouse and it acts as a production facility, in this situation it will be called as a capital good because this product of a house is being used in order to produce other goods. So this is the difference where one product can be a consumer good, and if used in a different situation, it can be a capital good. We'll move to the next set of concepts, final goods. Now those goods and services whose production process is complete are called as final goods. Now these goods can be both consumer goods and capital goods. For example, I have a nice shirt. Its production process is complete and I am wearing it right now. In this situation, this shirt is called as a final good because its production process is complete. On the other hand, if goods are still in the process of production or in the process of resale, these goods are called as intermediate goods. For example, raw wheat is now being put in a machine in order to prepare wheat flour. So this raw wheat will be called as an intermediate good, and the wheat flour, which is totally packed nicely in a bag, will be called as final good because its production process is complete. The same thing can be told to a cell phone. Now, if I'm using my cell phone, that is a final good because its production process has already been complete. But if that cell phone is being purchased by me for resale in my shop, then that cell phone will be an intermediate good because it is still in the process of production or resale. The same thing can be used with the example of milk. When I'm using milk for my coffee or tea, it's a final good. But if I'm using this milk to prepare butter, this milk will be in the process of production, and that is why it will be called as an intermediate good. We'll move to the next set of concepts, that is flow and stock. An economic variable which is measured over a period of time is called as flow. For example, salary which is paid to us every month, wages which is earned by us daily, or interest which is paid into our bank accounts quarterly. These economic variables are called as flow because they are happening over a specific period of time, over a continuous period of time. On the other hand, an economic variable which is measured only at a specific point of time is called as stock. For example, net profit is measured at the end of the year. Bank balance is measured when we request it from the bank. And so, a flow is an economic variable measured over a period of time which happens continuously, whereas a stock is an economic variable which is measured only at one point of time. While flow is a dynamic concept, which means it moves continuously, stock is that kind of economic variable which is static, which is measured only at one point of time. Now, the wealth of a person is a stock because it is measured at one point of time. But if the constant streams of income are increasing that wealth, that concept will be called as flow. We'll move into the next set of concepts, that is gross investment, capital consumption, and capital loss. It's very easy to understand. Whenever we increase the value of our capital goods, I already explained earlier, that increase in the value is called as gross investment. Now, if I have a machine, I am either purchasing another machine or I am upgrading the existing machine by increasing its capacity. That is called as gross investment because I am increasing the value of that machine. But the problem is, whenever we are using goods, their value reduces. Year after year, day after day, their value reduces, and at a particular point of time they will be totally used up. This is called as wear and tear or obsolescence, where our machine becomes outdated. And so the reduction in this value of this asset or the reduction in the value of capital goods is called as capital consumption, because we are constantly consuming the value of these capital goods. In accountancy, this is called as depreciation. The common example is the use of a motor vehicle. When we purchase it, it's brand new, having a nice value. But after 5 to 10 years, the value will not be the same. The value will be reduced because of constant usage, and slowly it will be outdated. And specifically according to the Indian law, after 15 to 20 years, that vehicle cannot be used to ply on the roads because it is undergoing obsolescence or it has become outdated. And so the constant use of the value of this motor vehicle is called as capital consumption, and in terms of accountancy, it's called as depreciation. The next concept is capital loss. Now, if I have a motor vehicle and I had an accident, and because of that there is a sudden reduction or a loss in the value of that capital good, that sudden loss due to unforeseen calamities is called as capital loss. For example, the accident of my motor vehicle has destroyed the front part, and because of that there is a sudden reduction in the value of the motor vehicle. The same thing can be told about a cell phone or a laptop. When I am increasing or upgrading my cell phone by paying a bit, or I am installing a new graphics card in my laptop, I am doing something called as gross investment, because I am increasing the value of my cell phone and laptop. But if I am constantly using up my cell phone and laptop, after a few years the value will not be the same, because I have constantly consumed the value of my cell phone and laptop. That's called as capital consumption or depreciation. If I throw my cell phone at the wall and break it, or if my laptop gets short circuit and bursts into flames, that's called as capital loss, because it's a loss due to unforeseen calamities that have happened. This is the difference between gross investment and the meaning of capital consumption and capital loss. We will move into the next set of concepts, that is factors of production. We have already studied this in class 10th and 11th. I hope so to explain in our future videos in detail. In economics, we have 4 important factors of production: land, labor, capital, and organization. If a person has land and land is being utilized in order to earn income, one can lease out or rent it out and earn rent. If a person is doing labor, in return that person earns the income in the form of salary or wages. If a person has invested capital in a business, that person will earn interest on capital. And if a person is organizing a business, that person will earn profit. And so if you have these 4 factors of production, definitely you will earn income either in the form of rent, salary, wages, interest, or profit. And with that, we come to the end of this first video, which was on national income and related aggregates, where I have explained the basic terms. Stay tuned in this channel, where in the next video I will explain about the circular flow of income and then move into national income proper. Thank you so much for staying tuned till now. Feel free to explain or express your doubts in the comments so that I can be more effective. And stay tuned. Please like, share and subscribe so that many more students will be benefited from it. Thank you so much. Stay educated and stay safe.